One strike just rewired the global money system because when the United States hit Venezuela, the obvious story was military. The real story was economic. A sitting president captured, charges waiting in New York. And yet, something critical was deliberately left untouched. Not accidentally, not by luck. Venezuela's oil infrastructure stayed intact. Refineries, export ports, production facilities, all spared. That's not how punishment looks. That's how preparation looks. Here's the contradiction that matters to you. Venezuela holds over 300 billion barrels of proven oil reserves, more than Saudi Arabia, more than Russia, more than anyone. And yet the strike wasn't about destroying supply. It was about securing it, because oil isn't just fuel. It quietly decides inflation, asset prices, and whether your money buys more next year or less. If you're thinking this only affects traders or energy companies, pause. Energy prices leak into everything: groceries, transport, manufacturing, rent, even the cost of things you don't associate with oil at all. When energy moves, your purchasing power follows, whether you're 100% in stocks or not. And here's the part most coverage skips. This didn't happen in isolation. The oil facilities were left operational because someone wants them running soon, on purpose. And that single decision doesn't just shift oil markets. It changes how gold is treated, how silver behaves, and how quietly the dollar system gets stressed without headlines. So before we talk about prices or profits, ask yourself this: why would a military strike protect the most valuable energy reserves on Earth instead of destroying them? What happened next explains everything. Last Friday night, according to the account you saw, the United States launched a military strike against Venezuela. Nicolas Maduro was captured and now faces narco-terrorism charges in New York. That alone would normally dominate every headline, but here's where the story immediately breaks from the script. The oil infrastructure wasn't hit. Not the refineries, not the export ports, not the production facilities. The damage came from years of mismanagement, not from bombs. That detail matters more than the arrest itself, because Venezuela isn't just another oil producer. It holds roughly 303 billion barrels of proven reserves, about 17% of all the oil on the planet, more than Saudi Arabia, more than Russia, more than anyone. And instead of wiping that off the board, the strike preserved it. Now zoom out for a second. At peak production, Venezuela was pumping around 3.5 million barrels per day. Today, it's under 1 million. Infrastructure is old, decades old. Experts cited here estimate it could take between $58 and $100 billion just to restore production to previous levels. And when asked about timelines, there's a sharp split. Political confidence says months. Industry reality says years. But here's the question that reframes the entire event. If this were simply about removing a regime, why immediately start talking about rebuilding oil production? Why publicly discuss American oil companies stepping in? And why make it clear that the oil needs to keep flowing? Because this isn't just an intervention. It fits into a much larger pattern. Control energy, and you quietly control inflation. Control inflation, and you control debt, markets, and political pressure at home. That's the lens most people aren't using yet. And once you see it that way, the strike itself becomes less important than what it enables next. Here's the claim that makes this uncomfortable. This wasn't designed to shock markets. It was designed to prepare them. Look at the specifics that were already disclosed. Trump openly said rebuilding Venezuela's oil industry would require a tremendous amount of money, and that oil companies would spend it, then get reimbursed by us or through revenue. That's not speculation. That's a public signal. American oil companies aren't being warned off. They're being invited in. And the timeline matters. Venezuela is set to transfer between 30 and 50 million barrels of oil to the United States. Chevron already has 11 tankers contracted, scheduled to arrive at Venezuelan ports later this month, not next year. This month. That's not theory. That's logistics in motion. Now pause on what's missing. There's no talk of sanctions tightening, no discussion of shutting production down, no threats against exports. Instead, there's coordination, shipping schedules, and reimbursement language. Notice what they didn't deny. This is about restoring flow, not restricting it. And here's why that flips the story. Venezuelan oil isn't just oil. It's heavy crude, thick, difficult, expensive to extract, the kind of oil most countries don't want to deal with. But the United States does, for a very specific reason that goes back decades. Because once you understand how U.S. refineries were built, this stops looking like foreign policy and starts looking like infrastructure math. Now watch how this escalates. In the 1970s, the United States adjusted its Gulf Coast refineries to handle heavy crude. This wasn't some minor tweak. It was a multi-billion-dollar infrastructure shift designed for the long-term belief that light oil supplies would eventually dry up. They didn't. Fracking changed everything. But those refineries are still set up to handle heavy crude. The U.S. is locked in. It cannot suddenly switch back without incurring huge costs. The world's oil supply had shifted, but the U.S. infrastructure didn't follow. Here's where it gets interesting. 70% of U.S. oil imports are heavy crude, and for the most part, they come from Canada. That's where the U.S. has been getting its supply. Now, Venezuela's heavy crude can replace a huge portion of that using the same refineries, same equipment, same process. This isn't just an oil story. It's a strategic decision to shift dependence away from Canada and onto Venezuela, who happens to be much closer and, for all practical purposes, now has a new partnership with the U.S. government. Now, think about the bigger picture. Venezuelan oil ramps up and it shifts everything. This doesn't just affect energy markets. It reorders global trade flows. It moves beyond oil into dollars, into supply chains, and into the broader economy. The U.S. doesn't just gain a new source of oil, it gains leverage over the global energy market. So here's the real consequence that most people aren't seeing. Venezuela's oil comes at a higher cost, no question. But with massive U.S. investment in infrastructure, this isn't just about oil. It's about cost control, it's about keeping inflation in check, and it's about flooding the market with cheap energy when the U.S. needs it most to fight off inflation, to manage debt, and to keep consumer prices stable. What happens if this continues? This is where the real tension builds. When you increase the oil supply, everything gets cheaper. Gasoline, heating, transportation, plastics, manufacturing, even the cost of food goes down. Venezuela's oil infrastructure is aging and underperforming, but with U.S. backing, it could flood global markets with oil. It's going to lower energy prices across the board. And that's not just a ripple effect. It's a massive deflationary play. Here's why that's critical. As energy costs fall, everything connected to it gets cheaper. That includes production costs for nearly everything. Manufacturing, shipping, even food production, all those industries depend heavily on energy. So if Venezuela starts pumping more oil, it won't just stabilize global oil prices. It will lower the cost of almost every product you buy. Now here's where this takes a darker turn. This deflationary cycle might seem like good news for you, for your family, for your budget, but when you dig deeper, you realize it's a double-edged sword. Because the lower costs, the cheaper goods, the stable inflation, it all comes with a price, a very big price. Think about the U.S. government's $38 trillion debt. That's not just a number on a page. It's the weight that's been hanging over this entire economy for years. And the solution? Inflation. You inflate the debt away by keeping inflation low enough to disguise it. The real trick, keep the public from realizing how much wealth they're losing in the process. How do you do that? By keeping energy cheap, by flooding the market with Venezuelan oil. That's how you control inflation at the gas pump, but still let the rich get richer. It's an elegant solution, and one that doesn't require headlines or mass public awareness. So now the question isn't whether oil will get cheaper, it will. The question is, who's going to lose when everything else gets quietly more expensive for the average person? Now the pressure starts stacking. Because this doesn't move in one clean line, it hits in layers. First, oil. Venezuela begins transferring 30 to 50 million barrels to the United States. Chevron already has 11 tankers scheduled. That's immediate flow, not theory, not projection. Ships are already booked. Second layer, rebuilding. Estimates say restoring Venezuela's production capacity could cost anywhere from $58 to $100 billion. Trump says it could be done fast. Industry experts say years. But either way, the signal is clear. American oil majors aren't just buying oil. They're being positioned to rebuild an entire energy system with subsidies, reimbursements, and long-term access baked in. Third layer, substitution. Venezuelan heavy crude directly replaces Canadian heavy crude. Same refineries, same processing, but closer to U.S. Gulf Coast ports. Cheaper to transport and politically easier to control. That means Canadian producers, who've been the quiet winners of the last energy cycle, suddenly face competition they didn't have last week. Notice how fast this stacks up. Supply increases, costs fall, trade routes shift. Winners and losers get reassigned without a single vote or announcement. This isn't chaos, it's momentum. And momentum doesn't wait for public understanding to catch up. So here's the uncomfortable question. If energy prices keep dropping, if inflation stays calm on the surface, and if governments quietly get what they need, what breaks underneath? Now bring it back to yourself. Because this isn't abstract anymore. This is where it reaches your daily life. When energy costs fall, it feels like relief. Gas gets cheaper, shipping costs drop, prices stop rising as fast. On paper, inflation looks under control. But your salary doesn't suddenly jump. Your savings don't magically compound faster. And quietly, the gap between people who own assets and people who don't starts widening again. Here's the lived effect. If oil floods the market, companies benefit first. Their input costs drop immediately. Margins expand, stock prices respond. Asset holders win early, but wages adjust slowly, if at all. So even as things feel stable at the checkout line, purchasing power shifts away from anyone who depends mainly on income. This is why energy policy is never just about energy. It decides who absorbs inflation and who escapes it. And it happens without ideology, without speeches, without votes, just flows of oil, contracts, and infrastructure spending. If you've ever felt like prices calm down but life still feels harder, this is why. The system doesn't need inflation to hurt you loudly. It just needs it to move sideways into assets you don't own yet. If this feels familiar, say so in the comments. Because once you see how this works at the personal level, the next question isn't outrage. It's understanding the mechanism that keeps letting this happen again and again. Here's the mechanism most coverage never explains. This isn't driven by ideology, it's driven by incentives. Governments with massive debt need growth without visible inflation. Markets need stability without tightening. And voters need calm prices at the gas station more than anything else. Energy is the pressure valve that makes all three possible at the same time. When oil supply expands, it suppresses headline inflation. That gives policymakers room to keep interest rates lower than they otherwise could. Lower real rates quietly erode the value of debt over time. That's not theory. The content itself points to precedent. After World War II, U.S. debt sat at over 100% of GDP. By the mid-1970s, it had collapsed to a fraction of that, not through repayment, through inflation running above interest rates for years. Now connect that to today. The U.S. carries roughly $38 trillion in debt and pays about $1 trillion a year just in interest. According to the account, J.P. Morgan's outlook explicitly states that policymakers will inflate the debt away by driving inflation while keeping real rates low. But here's the constraint. Inflation can't feel painful. If it does, political pressure explodes. That's where Venezuela fits. Flood energy markets, keep gasoline cheap, let asset prices run, stocks, real estate, gold, quietly inflate the system while the most visible prices stay calm. It's not a conspiracy. It's a system doing what it's built to do. And once you see that, this stops being a Venezuela story. It becomes a playbook, one that explains why gold and silver start behaving differently next. This is where the signals get harder to ignore because while energy prices are being managed, something else is happening quietly in the background. Central banks are buying gold. A lot of it, according to the content, they've been purchasing over 1,000 tons annually since 2022. That's double the average of the previous decade, and the timing matters. In October 2025, central banks bought aggressively during a price pullback just 1 month after the first U.S. strikes on Venezuelan boats. That's not random behavior. That's response. After the U.S. froze Russian assets in 2022, every country watching learned the same lesson. Assets held in dollars or U.S. government bonds can be neutralized instantly. It doesn't matter whether you think that action was justified. What matters is the signal it sent. If it can happen once, it can happen again. And once that realization sets in, reserve strategy changes. Venezuela was already moving away from the dollar. It joined BRICS. China became its largest oil buyer. And now suddenly the U.S. controls its oil output again, not through sanctions, through access, through infrastructure, through logistics. The message to other countries is subtle but clear. Energy can be redirected. Dollars can be frozen. But gold held in your own vault can't be clicked off. So gold stops behaving like a trade and starts behaving like insurance. And silver follows for a different reason. Industrial demand, supply tightness, export controls, the paper market straining against physical reality. When physical metal matters more than contracts, prices stop responding to narratives and start responding to scarcity. This is the shift most people miss because it doesn't announce itself. It just shows up in buying patterns first. And once metals start moving this way, the effects don't stop there. They spill into an entirely different sector that benefits from both cheaper energy and higher metal prices at the same time. Now look forward, not backward. From here, the story splits into two paths, and neither is clean. In the first path, Venezuela's oil production ramps slowly. Infrastructure takes years to rebuild. Supply increases, but not enough to shock the system. Energy prices drift lower. Inflation stays calm on the surface. Policymakers get breathing room. Asset prices continue climbing. Gold and silver rise steadily, not explosively, as central banks keep buying quietly in the background. In the second path, the rebuild moves faster than expected. Capital floods in. Heavy crude volumes surge. Oil prices come under real pressure. Deflation spreads through energy-intensive industries. Manufacturing costs drop. Transportation gets cheaper. And suddenly, margins expand everywhere except wages. Markets cheer. Headlines celebrate stable inflation. But underneath, the divide between asset owners and everyone else widens even faster. Neither outcome is guaranteed, but momentum is already forming. Tankers are booked, contracts are signed, capital is lining up. These aren't debates anymore, they're sequences. And once sequences start, they're hard to stop without breaking something else. So the real uncertainty isn't whether this matters. It's how fast it compounds and whether people realize what's happening before the next move locks in. Because the final impact of this shift doesn't show up in oil prices first. It shows up in who's prepared when the system quietly finishes rebalancing itself.